Now we want to touch on what is happening on the service side. And it's one of the key pieces that we've talked about is the increase in activity that remains on the service sector side, and how that is going to be a problem when you look at just, again, the inflation piece. And I saw some things that some people were saying that inflation's only on the housing front. But again, if you look at services, that's not the case. Like, there is a lot of this sticky core piece of the inflation cycle that remains problematic, and it continues to move through the system. ISM services came in at 55.1 versus the estimate of 54.5. New orders were up to 62.6. Prices came down, but they're still at 65.6. So you're still seeing expansion in pricing, just at a slightly slower clip, but that's still a meaningful number when you think of that as business activity fell to 56.3. Now, employment also moved up. Supplier deliveries is the only component in contraction. So again, when you look at the backdrop, this is something that's showing you some pretty aggressive numbers for February, which is why we talked about some of those in the inflation data that's going to come out for where February is, and more of that support for why we're going to see those increases in rates, and why a 50 basis point increase versus 25 is much more likely at this point going forward. Now, when you look at supplier delivery times, just kind of pulling some important pieces out, you can see that there's the supply chain is caught up with itself. There's really nothing left in there as employment started to pick back up. Now, as employment picks up, I don't know if people have started looking at hotels or what they're going to do for summer, but prices are elevated, and it's just going to be a question of, a lot of that is driven by employment, a lot of that is driven by wages, and just what it costs, again, to operate a normal facility at this point. Prices paid, you can see, is at 65.6, but it gives you the idea that, yes, are we at 85? No, but we're still very elevated versus previous, and this is where we see the stickiness at this point in time when you look at the service side, and again, how that hits the core front, because services is a sticky component of the inflation calculation, and why we see some of those pressure points continuing. Now, productivity struggled in 2022, falling by 1.8% year on year in the fourth quarter, which is among the worst drops in history. And a lot of that is because you had a lot of retirements. You had a lot of people that were looking for jobs because they could get a better wage somewhere else. And that has started to dry up. But that creates a productivity issue, because somebody who is, so just think of it holistically for anybody who's had a new job. When you start a new job, you have to be trained. So there's no way, no matter how smart you are, that you're going to be as good as the person you're replacing, or at least as someone, another good person in the organization for 6 months. There's going to take that learning curve, but also you need someone to train you. So now the person who, and typically the person who's training you is someone who is deemed to be very good at their job. So they're going to be less efficient. You're already less efficient. So now you have two people that are not optimized, which is why, as you get this big cycle through, you get some of those different pressure points. Job openings percentage changed since February 2020. Again, they're coming down, but you get an idea they're still elevated. And that, again, is why we see a lot of the stickiness on the wage front, which then bleeds into our estimates for inflation. Average credit card balances, as you can see, Gen X is king of the roost, coming in at about the average card balance being about $9,000. When you look at millennials, a bit lower, coming in at just under $7,000, and then that's baby boomers right there. Consumer credit card 90-day delinquency, you can see millennials, Gen Z, Gen X, but they're all moving up. They're moving up at, obviously different places, but look at the rate of change. And that's the concern, because the rate of change is aggressive, and we have the most credit card debt in history on our sheets. So that just means that the pressure to maintain it is getting harder and harder, and we have the most of it ever with the highest rates ever. So all of those pieces, so we have elevated cost of living, highest credit card rates in history, most credit card debt in history. So this delinquency rate is only going to go higher because, again, inflation's not going anywhere. There's still that pressure, which is why we're going to continue to see this moving up. Now, the bottom 20% of income earners only account for only 9% of consumption. But when you look at the second and lowest quintile, that's what we've been talking about. For those that watch the EIA show, when we talked about some of the softness into the summer driving season, though the third, second, and lowest, that's kind of that swing. The top quintile is always going to go away. They're going to go away. There was never a thought in their mind that they weren't going to go away. But that's why when we look at gasoline demand, we say it's going to be lower. It's because that top quintile, they're gone. It's going to happen. They're going to be going. But what about the fourth, third, second, and lowest? How many of them are going to say, you know what, this year is really tough, not going to be able to swing it? That is why we're going to have it. So demand's going to go up. It's just going to be at a step down of what is normal. U.S. households still have the pent-up savings, but it's a matter of where does it sit. So yes, the most of it is left at the top quintile, but they were always going to spend. So when you think of, they're not really going to spend more than normal. They're going to spend their normal amount, which is why you're seeing more and more brands catering to it, trying to bridge the gap, because you're starting to see a lot of the slowdowns further down that line, which is why we see the slowdown in consumers and and retail sales. But that's going to be, again, difficult to nail down because you still get that top quintile that's out there fairly active. U.S. unit labor costs, you can see the survey was from 1.6%, came in at 3.2%. And that's where you see this elevated piece. But look at how Q4 ended and how it's kind of flatlining. And then you look at the data that we talked about in the previous segment. There's no reason unit labor cost is going to come down quarter on quarter. It could come down a bit year on year, but realistically, quarter on quarter, it's going to remain elevated just in general because the costs are higher, and that's where that's going to eat into some of these vacations, some of the spending that we've been talking about. Now we've had a convergence lately for inventory components within the ISM manufacturing. Blue falling and services rising. But this is what we've been talking about, where you had manufacturing that just blew to the moon and that drew down inventories because everybody got these checks. And so they were buying TVs and everything else. And then you had supply chain issues. So now you have you're one of the things that we've been saying is it's a meet in the middle. You're not going to get this huge collapse of manufacturing inventories and services staying low. No, it's going to be that meet in the middle. But as services goes up, as manufacturing normalizes, that's where you're going to see, okay, well, where does the pricing shake out? Notable divergence lately between employment components for ISM manufacturing and services because manufacturing is weak. As we've said, people got government money in 2020 and 2021. And it's easy to go out and buy stuff. That's what people did. They bought stuff with it. And now services is coming back up because there's only so many TVs you're going to buy in a 5-year period. There's only so many stereos or new headphones or phones. So there's only so much. Where services, there's things that can be done. There's things that you can add. Everything and their mother at this point has a streaming service. So, and everybody has a podcast because why not? So when you look at some of these pieces, that's where you're getting a lot of these additional costs. Prices paid components for ISM manufacturing popped into expansion in February. Prices paid for services fell, but remains in expansion. So now you get both sides of it being, but again, manufacturing is right on the cusp. Could it be flat? Sure. But it's just, you're not getting any deflationary prints here. You're getting a lot of pressure to the upside and really keeping this in our stagflationary backdrop, which is really kind of the base case that we've been highlighting. Supply chain bottlenecks clearly in rear view as supplier delivery components for both ISM manufacturing and service PMIs remain firmly in contraction, which is, again, kind of basic of what we've been talking about with supply chains being normal. Sharp move lower in private residential construction. But again, sharp move lower is relative when you look at, well, what is the quote unquote sharp move? Yes, on a 6-month annualized basis, it's sharp, but holistically speaking, it's still high, but you can see that the pressure is accelerating to the downside. Most U.S. mortgages, so data from Black Knight show that over 40% of all U.S. mortgages were originated in 2020 or 2021 when pandemic drove borrowing costs to historic lows. Good news for homeowners who locked in cheap loans. Note the x-axis again begins with 2023 on left. But think about, so you might be like, well, 40% of the world, country didn't move. It's like, no, but people refinance their mortgage. So that would show up in just terms of the vintage when you look at when people got loans. I mean, this is a fairly elevated number when you look at it, which is why people are now kind of stuck where they are, because you refinance, but refinance at what was the house value of it? How much did you take cash out? If you did, what does that mean for your math? Over half of U.S. mortgages originated in 22 or later. The Fed, which held 0 MBS in 2008, held almost $1.4 trillion in March of 2020, then doubled their holdings by April 2022. Again, that is a criminal distortion of the housing market, which is why asset prices are so absurd. And there's going to be tightness. There's going to be more pressure, which is why we see so much downside to that the housing market in general. With the when you look at mortgages showing additional slowdowns, but there is a seasonal increase. So we're going to get a seasonal increase. It's just, as you can see, going to be at a much lower rate, especially when you start looking at purchases in general being at the very low end. Now, when you look at the typical U.S. homeowner spends 12.3 years in their house, which is down from the peak of 13.4. But again, that could come back up as the affordability index just collapses, and a lot of that is based on rates. So when you look at the divergence between rates, price, and then where income is, well, is income going up? In order to change this model, you need to see prices come down. You need to see all of these pieces, but rates are going to stay elevated, and income's not going to close that gap. So again, even though it won't stay at some of these extremes, it's going to tighten, but then stay fairly unaffordable, if you will, for a fairly sizable period of time until those prices come down and you start to see, again, some of that turnover. Current status of loans that have left COVID forbearance plans. When you look at the different movements in general, the distribution of first lien mortgages by current interest rates, you can see just where they are in general and a lot of the reasons why we're seeing some of these different pieces. But look at the current status of some of these loans that have left COVID-19 forbearance plans. You have active losses starting to increase as we progress through. You have delinquency starting to increase, and this stress is only going to get worse as rates go up and these debt levels continue to compound. So when you look at HP1 forecast percentage change, you can see that 3.1% forecast for January 2024, while as housing affordability continues to come down, which is why we do see some of these prices, again, getting pressed lower and coming in line with some of the, again, not to say that we're going to come down to 2009 levels, but we don't think we go positive as quickly, but that's going to be something that we're going to watch over the next few months and really, until we see a meaningful change in the underlying data. So that's what we have for you in the U.S. In the next segment, we're going to go deeper into Europe and what are some of the things happening on the European front.